But I think more important than some of these economic data points is what's actually going on in the economy as admitted by some of these corporations while they're releasing their earnings. This is particularly true when it comes to Walmart, which actually beat on both revenue and earnings. Let's see the experts try to dismiss that and claim that even 3/4 of declining GDP still doesn't constitute a recession. But even though it beat on earnings, year over year, earnings were still down. It's just that they weren't down as much as investors had expected. So this was being heralded as good news because it was a beat, and Walmart's share price went up as a result of the good news. But I think looking beneath the headlines, the news was not nearly as good when looking at what's actually going on with Walmart customers. First of all, one of the comments that was made that Walmart noticed an increase of more affluent customers shopping at its stores. Now, what does that tell you? Well, people are trading down. People that didn't shop at Walmart because they shopped at more expensive stores because they're getting squeezed by inflation, because their rent is up or their mortgage is up, their food costs are up, their energy costs are up. They don't have as much discretionary income. So in order to get by, they are trading down. They prefer to shop at fancier stores that have maybe better merchandise, more expensive merchandise, but they can't afford that stuff anymore. The only thing they can afford is Walmart. And so while that may be a good sign for Walmart, it's a bad sign for the overall economy that so many people that used to be wealthy enough not to have to shop at Walmart have now seen their wealth diminish to the point where Walmart is all they can afford. Also, Walmart mentioned that they're seeing an increase in the use of credit cards over debit cards. Again, what is that telling you? Well, it means that Walmart customers don't have enough cash in their bank accounts to buy stuff using their debit cards. So now they have to put stuff on their credit cards because they're buying stuff that they can't afford. Why? Well, because prices are going up, and they're going up by such a degree that customers can no longer afford to pay cash, and so they're relying on credit as a lifeline. We had a similar story with retail sales, although the headline number came out a bit weaker than expected. The rest of the report was stronger. And again, retail sales not adjusted for inflation. Clearly, in real terms, sales are falling. People are buying less and paying more. That's the story. That's not strength, that's weakness. But the expectation was for a 0.1% rise in retail sales. Instead, retail sales were flat, so no rise at all. And in fact, the prior month's gain of 1% was revised down to 0.8. But we also got a better than expected report on industrial production for July. And the prior month was reported as minus 0.2, and the expectation was for plus 0.3. Well, they revised the prior month up to 0. And instead of being up 0.3, July came in at up 0.6, which was double what had been expected, but was still within the range of expectations. But nonetheless, it was a beat. Now, of course, you got to take all this with a grain of salt because none of these numbers are adjusted for inflation. So obviously, when you have a lot of inflation, industrial production, at least the price of it, is going to go up because the price of producing anything is going up. So whether or not in real terms industrial production went up remains to be seen. Maybe we produce less. It's just that the stuff that we did produce cost more. Now, the same story with manufacturing output. That was expected to rise by 0.2. Instead, it rose by 0.7. They even took the prior month's decline of minus 0.5 and made it just minus 0.4. So again, stronger data there. I mean, the data isn't strong. It just isn't as weak as expectations. And capacity utilization went up to 80.3. The expectation was for a rise to 80.1, although the prior month was actually revised down a bit from 80 even to 79.9. But again, this was part of the data that maybe investors were bracing for worse than expected. We got better than expected. And so that was not the news that the markets wanted, because again, it's bad news is good news, which means good news is bad news. And so this was bad news that weighed on stocks, but it also weighed on foreign currencies. It weighed on gold. It weighed on bonds. X vehicles, it was a bit of a different story. They were expecting a minus 0.1. Instead, we got a plus 0.4. And if you X'd out gasoline and vehicles, instead of being up 0.3, we were up 0.7. So again, adjusted for inflation, probably not a real rise. But again, the markets had been getting a lot of negative economic news, and now all of a sudden, the negative news isn't as bad. We were beating expectations. Granted, the bar had been lowered quite a bit, but we were able to get over that bar. And again, that's not what the markets wanted to hear. Same thing with jobless claims. We had been going up in weekly jobless claims. Now we've been moving back. We had a revision to the prior week, which was reported as 262,000. That was revised down to 252,000. The expectation for this week was 265,000. We came in at 250. So these are a bit softer. We're still a lot higher than we were 6 months ago, but we've softened a little bit. So maybe that created a glimmer of hope that maybe the worst is behind us for the increase in claims. In fact, the 4-week moving average moved down a bit. It was 252,000 last week. They revised that down to 249,500. And this most recent week, it came out lower again at 246,750. Now, because I don't think this is a change of trend. I think this is just a slight correction. I think we're headed a lot higher in unemployment claims. But for now, the market's got a bit of a breather, and that continued to fuel the narrative of a tougher Fed. But probably one of the more significant beats was the Philadelphia Fed manufacturing survey, because a lot of people were bracing for a really bad number given the abysmal number we got in the Empire State manufacturing number. So the consensus for the Philly Fed was for a decline of 5. And that would have been a smaller decline than the prior months of minus 12.3. Instead, we didn't get a decline at all. We got a rise of 6.2. Now, that's not a big number, but it's a lot better than what the markets had been expected. In fact, the range of expectations went from minus 15 to plus 2. So plus 6.2 was more than triple the high end of the range. And I think, again, that really helped drive this narrative that, hey, maybe the economy isn't as weak as we thought. The Fed is still resolute in its commitment to fight inflation. And so maybe we were a bit premature in pricing in the Powell pivot. So we better start pricing some of that out. And that's why you saw these big moves, not just in the stock market, but again, even bigger moves in the foreign exchange markets, the gold market, the cryptocurrency market, and the bond market. But despite some of this better than expected economic news on the week, if you look at the current prediction for Q3 GDP out of the Atlanta Fed, it's just for 1.6%. Now, granted, that would snap a 2-quarter losing streak of negative GDP, but we're still early in Q3. In fact, earlier in the month, the Atlanta Fed was looking for a 2.5%, I think, rise in Q3 GDP. So they've already ratcheted that down quite a bit. And if you go back to a similar point in time in Q2, the expectation at that time by the Atlanta Fed was for the GDP to be greater than plus 1.6, and it ended up as a negative 0.9. So I think it's still early in the quarter. For the first time, the prior month, it was up 9.4%. The consensus was July year over year would be up 9.8. Instead, the actual increase was 10.1%, which represents a 40-year high. Now, I think that really sent some shockwaves throughout the markets to get a look at a major economy like the UK with double-digit inflation. Now, I think in reality, the US has double-digit inflation, and the digits are a lot higher. In fact, this is the fifth consecutive month where the leading economic indicators have been negative. Now, that rarely happens. In fact, you have to go all the way back to the Great Recession of 2008, 2009 to see that happen. So something is happening right now with leading economic indicators that hasn't happened since the economy was in the middle of the worst recession since the Great Depression, yet all the experts are trying to convince us that we're not even in a recession right now.